So far, the concepts we've covered in this course have been quite straightforward and easy to apply. We talked about entry points. We simply wait for the RSI to cross above 75 or below 25. We talked about stop loss and the fact that we don't set any fixed stop loss with this strategy. And we talked about take profit. We use the ATR indicator, which provides precise profit targets without requiring any chart analysis. Now we reach the topic of lot sizing, also called position sizing. This section marks our final simple step before diving into two of the most challenging and critical areas of our strategy: position management and risk management. These two areas demand significant focus and energy, as they are the core of this trading strategy. For this reason, I strongly recommend keeping lot sizing as simple as possible. No need to spend additional focus and energy here. Before we continue, let's quickly clarify the difference between lot sizing and risk management, because traders often confuse these two concepts. Lot sizing refers to deciding how big each trade will be. It defines how many lots you will trade with each position. Risk management involves deciding how much risk you're willing to accept for each trade and across your entire trading account. It includes defining acceptable drawdowns, acceptable swings in your account, and planning for adverse market events, among other things. So, lot sizing is about deciding how many lots for each trade, while risk management addresses how safely you handle your capital for each trade and for your account over the long term. Of course, the two are related, since position sizing is one of the main factors that affects risk management. Having clarified this, the most common method of lot sizing in trading involves risking a certain percentage of your account balance per trade, and then calculating the lot size accordingly. For example, many traders risk 1% of their balance per trade, which means that they calculate 1% of their trading balance, and then they calculate the amount of lots they need to open to risk that 1% of their balance on that specific trade. While this is logical and it is the main approach to position sizing, it can be time-consuming and energy-consuming, especially because our strategy takes many trades per day, so you will need to calculate your correct position sizing several times per day while under pressure of setting up your trades quickly. Considering what we have said before, that we need full focus for position management and risk management later on, for this strategy, I recommend using a simple fixed lot sizing approach. With fixed lot sizing, you determine your trade size based on the overall amount of money in your account. It's really quite simple. For every specific amount in your account, you trade a defined lot size. For example, we define that for every $1,000 in our trading account, we trade 0.01 lot per position. This means that if we have $15,000 in our account, we trade 0.15 lots per position. If we have $70,000 in our account, we trade with 0.70 lots per position. And this allows you to quickly and easily calculate your lot sizing without spending time and energy on it. Now, my personal recommendation for this strategy, after extensive testing and after applying it myself in real market conditions for over 2 years, is to trade 0.02 lots for every $5,000 you have in your trading account. So if you have $5,000, your lot size is 0.02 lots per trade. If you have $10,000, you can increase to 0.04 lots per trade. At $15,000, you can trade 0.06 lots per trade, and so on like this. The first thing you may notice is that I increase my lot size by an even number, 0.02 in this case. Why is that? Why not 0.01, for example? Our strategy involves splitting trades into two halves so that we can set precise take profits. Using an even number of lots for our trades allows us to split our trades precisely. For example, 0.02 lots can be split into two positions of 0.01 lot each, while we couldn't split precisely a position of 0.03 lots, for example. The second thing you may notice is that I recommend starting with at least $5,000. Now, my recommendation of starting with at least $5,000 is because it allows conservative and sustainable risk management, helping keep your potential drawdown within 20%, even under extreme market volatility or unexpected black swan events. However, I understand that some traders might prefer a more aggressive trading style to grow their accounts faster, or they may simply not have $5,000 available to trade. In either case, you might consider increasing your risk level. If you decide to adopt a more aggressive approach, whether due to limited starting capital or personal preference, my recommendation is still not to exceed 0.02 lots per $1,000 in your account. According to thousands of simulations and backtests that I have conducted, this represents the maximum aggressive position sizing that remains sustainable over time. Anything beyond that, such as 0.02 lots per $500, crosses the boundary from aggressive trading into pure gambling, and it significantly raises the likelihood of blowing your entire account during periods of extreme market conditions. Now, what if you don't even have $1,000? Or what if you want to start with a smaller amount? Does this mean that you cannot apply this strategy with a good risk management? If you're not able to start trading with even $1,000, don't worry. I'll address this concern later in the course with a dedicated lecture on how to safely grow a small trading account, ensuring you never risk more than you can afford to lose. So I've got you covered even if you don't have $1,000 to start with this trading strategy. For the rest of the course, in our live trading sessions, we will follow the recommended lot sizing of 0.02 lots for every $5,000 in our account balance. With lot sizing now clearly explained and defined, we are ready to move forward. Next up, we are going to have another live trading session to apply position sizing in our trading. Then we'll dive deep into position management and risk management.